Today's episode, we delve into the crucial world of bookkeeping, focusing on adjusting entries. Adjusting entries ensure that your financial records reflect accurate and up-to-date information. They are essential for adhering to the matching principle in accounting and ensuring that income and expenses are recorded in the correct periods. Let's explore the different types of adjusting entries you might encounter. First, we have accruals. Accruals are all about timing. They involve recording expenses and revenues that have been incurred or earned, but not yet recorded in the accounts. Imagine you've completed a service in December, but won't be paid until January. An accrual entry would record this revenue in December, matching the revenue with the period in which the service was performed. Next up is deferrals. With deferrals, you're dealing with transactions where cash has changed hands, but the actual revenue or expense has not yet been recognized. A common example is prepaid rent. If you pay rent for the first 6 months up front, you'll need to spread that expense over the appropriate periods to accurately reflect your financial position each month. Moving on, we have depreciation. This is an adjusting entry focused on fixed assets. Over time, assets like vehicles and equipment lose value. By creating a depreciation entry, you ensure that this loss of value is gradually accounted for, aligning the expense with the periods benefiting from the asset's use. Another important type is inventory adjustments. These adjustments reflect changes in inventory levels from physical counts compared to what's recorded in the books. Discrepancies can arise from theft, spoilage, or administrative errors, and these entries help maintain accurate financial statements. Lastly, we have estimates. These include adjusting entries for doubtful accounts or warranties. Sometimes you won't know the exact figures until later, so estimates ensure that financial statements reflect potential losses or expenses based on the best available information. In conclusion, adjusting entries are vital for accurate financial reporting. They bridge the gap between cash flow and the true financial operation of your business. Understanding these entries allows you to present a clear and honest picture of your company's financial health.